Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. 13 weeks ago, I was pondering on this market and my musings then were thus, and I quote, "Take a look at the whole big action since the peak in May today as just possibly a very large bearish halfway hesitation in the making. To clarify, it's possibly in the making and is not made, not yet. This is a ginormous pattern and one which eventually leads down to something like the 225 area. I am not prepared to call it that, not yet. However, we may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is a mid-June to date bear channel, and that's currently between 240 and 315, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, then these are worth considering." End of quote. These still stand, these comments, and both have merit. Indeed, the lower bear channel line turned the market higher in late March. To this, I added 6 weeks ago a further short-term pattern, a mid-November to late December 2022 bearish shift pitchfork, and this worked well in showing the bearish angle of attack for a while. But by last week, it was getting very ragged. Thus, I've retired it. Instead, I've drawn a more recent late December 2022, mid-February 2023 bearish Andrews pitchfork, the one you can see highlighted in dark blue on my daily chart. This does a better job of capturing the bearish angle of attack, with the current market in between the middle time below, currently 240.5, and the upper time above, currently 260 even. Looking afresh at this daily chart, we can see some obvious features. We can see how the market is getting bogged down in a stratified zone of supports and resistances between overhead 258 to 260, 252 to 255 and 250, and below between 245 to 247 and 238 to 242. On top of this, I draw your attention to the crossover of the lower bear channel line in bright green, channel line in bright green, and the middle time in dark blue that takes place early next week. If there were to be an attempt lower in the near future, then that crossover period would likely be the worst time to do it, unless the bearish pressure was really stacked high. Far better to wait until they separate their individual ways, and thus their power individually is less than their current combined support. London, UK feed wheat. Back in January, as the market punched through the short medium moving average, currently 216.30, up to the previous all-time high at 238.80, well, this old previous all-time high capped the rise, and from mid-February down to late March, we saw a drop down through the January low at 217.25, as well as the 2013 high at 215, the 2022 low at 206.5, and the March 2013 high at 205.05. Prices continued declining until 2 weeks ago, just when it looked like they may be heading lower still, and they reverted back up. This was initially something of a surprise, as the market was in an area seemingly devoid of significant supports. I can only think that perhaps one or more of three possible supportive factors may have caused the reversion back up. These are, and they're in no particular order, the September 2021 low at 181.70, the possibly powerful 50% Fibonacci line at 180.5, and item 3, something I had introduced 8 weeks ago, target X at 180 even. You see, I asked the following question back late last year, and I quote, "What if the action since mid-May to date is a huge bearish halfway hesitation, a really, really big one? In that case, we'll be looking at potential down in the 180 even area. Yes, 180. I'm not as yet advocating this as a pattern, but it might turn out to be. It will depend on how the market treats the congestion below." End of quote. 9 weeks ago, I decided to place a potential target X in the 180 even area, what is interesting about target X is that it's right by the previously mentioned 50% absolute Fibonacci line at 180.5. Perhaps these, however distant they may have seemed at the time, the influence of these two caused a halt and a move back up. The action also allowed me to draw a new bearish Andrews pitchfork for the very late October 2022 to February 2023 move. Initially, I was not wholly wedded to this pitchfork, as neither the upper tine, currently at 207.25, nor the lower tine, currently 172.5, had been tested. However, in the absence of anything else, I was minded to watch this pitchfork, and so far, it has been pretty good at indicating the bearish angle of attack. Late last week and this week, we've seen the market testing the resilience of the middle tine, which is currently 189.85, and it has held up on a closing basis. As I said earlier, I'm not wedded to this pitchfork, so don't be surprised if I retire it and use a bearish shift pitchfork for the same move or something else completely. But until that happens, watch this pitchfork carefully.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.